Hello everyone, Cian here, and this is my summary video about the second episode of the second month, and that is the secrets to selecting high reward setups. What makes the setup worth taking? Select trade setups on the higher time frame, because large institutions and banks analyze the markets only on a daily, weekly and monthly basis. So there's nothing less than a daily time frame. This means that all the PD arrays that are on a lower time frame than the daily time frame don't really have that much significance, right? So you mainly want to focus on the monthly PD arrays, the weekly PD arrays, and the daily PD arrays, right? These time frames should always be the foundation of your trade, right? Trade ID. So these time frames make you decide what your draw on liquidity is, what your bias is, and just your general trade ID, right? And locate price levels that align with institutional order flow. So look for higher time frame PD arrays, right? Because you always preferably want to be in alignment with the institutional order flow, because when you are in alignment with the institutional order flow, then you will have the highest probability setups. And remember that higher time frame setups form slow, so this means that it provides a lot of time for you to look at your plan and trade according to your plan, right? So higher time frame trading prevents fear of missing out, right? Prevents FOMO, because on the lower time frame, price moves so quickly that you're a lot of the times, for me personally, I am FOMOing into a trade, right? But on the higher time frame, you don't really have that problem because you have that much time. But on the other side, on the downside, all higher time frame setups also take a long time to hit TP, right? To play out. What can we do to lower the risk in a trade? So, first of all, the higher time frame has more influence on price, so your focus should be there, right? And always when you're charting, you have to refine the higher time frame levels to your lower time frame charts, right? Because when you do this, then it will allow for a smaller stop loss placement, right? So the conditions that lend to a trade setup on a higher time frame can be refined to a lower time frame. The conditions that lend to a trade setup on a higher time frame can be refined to a lower time frame, because price is fractal, right? Because imagine if I give you two charts, right? And I didn't give you the time frame or anything like that, right? I just purely price action, purely the candles. Then it would be very hard, maybe even impossible, to tell which time frame we are in, right? So this is what ICT means with price is fractal. And always transfer the higher time frame levels to lower time frame charts, because these higher time frame levels have so much significance on the lower time frame charts, right? What you see on the lower time frame charts is just a reflection of what is happening on the higher time frame, right? And you don't need big stop losses, but you do need a good knowledge about why you're putting your stop loss there. Some general notes: when marking up your charts, right, always check out the higher time frame and annotate it, right? Because like I said before, the higher time frame levels have a lot of significance on the lower time frame, so these are very important. So never just jump into a lower time frame and start trading right away, because this will make that you don't have a clear bias, 2, you don't really have good draw on liquidity, and 3, Like, how are you supposed to know where certain higher time frame PD arrays are? For example, imagine you go straight into a lower time frame, and on the lower time frame you see a market maker buy model. But once you go to the higher time frame, you see that we are trading into a bearish order block, a higher time frame bearish order block. Then on the lower time frame, it would make sense to go long, right? But when you combine these time frames, then you could see that it doesn't really make sense to go long, right? So that is the importance of higher time frame to lower time frame. The ICT interbank insight is understanding that smart money buys under sell side liquidity and sells above buy side liquidity. A minimum of 10 pip trades are valid, right? Because you don't really want to go much lower than that because of the spread. And it's easier for price on a lower time frame to hit a high RR. And of course it's always gonna be way faster, right, than on a higher time frame. Because on the lower time frame, these are smaller swings, right? Price swings. So they need less conviction behind it. So on the lower time frame, you could still be profitable without being in alignment with institutional order flow. You can put your stop loss above or below the mean threshold of an order block. Because when price violates the mean threshold of an order block, then you can expect price to violate the whole order block. So when annotating bullish order blocks, you want to annotate the upper part of the order block until the mean threshold, and vice versa for a bearish order block. Thank you for watching this summary video. Don't forget to like the video and subscribe to the channel. See you next time.